Hi everyone, welcome back to Paisa, Bolta. Today it's me and Kesav again recording. Hopefully this video will move along a little faster and with more information than us meandering through something which we did last video. I hope you guys forgive us for that one. Anyway, we'll try again, Kesav, today.
Yeah.
So what's on your mind?
So today I have to ask you that you always say that don't invest on active fund managers.
Correct.
Don't go on that side. I have to ask you, but it is there. Active fund, it is there.
Very much.
When there is no use of it, why it is there? Or else, do we have to look what are all we want to look when we have to choose an active fund manager?
Correct. As Kesav rightly said, we do strongly discourage you from involving yourself in active fund managers.
Yeah.
Because whatever an active fund manager is doing, you can do for yourself, by yourself. There's no rocket science to it, is what we always preach. But that being said, a lot of us don't have time, like Kesav says, to invest.
Yeah, sir.
To go through what an active fund manager, where he's investing, and to buy the shares yourself. Yes, theoretically it's all doable, but practically everyone has a job. And we don't have time to do it.
Yeah.
So there are certain things you should look at when you're
Investing in
active fund manager. You should look at the fund manager, like you rightly said.
Okay.
Not at the fund.
Fund manager. Okay. What are they
Because
doing?
what you must realize is the fund is as good as the manager.
Okay.
Why does CSK win? Because of Dhoni.
Dhoni.
Why? Because Dhoni forms the team. He puts together. He brings in all these guys. Jadeja and everyone. And he decides who should go bat when. In the dugout he's sitting. When he sees a run rate drop, he'll send the next guy. He'll jump one guy in front of the other. All that is controlled by Dhoni. That's what a fund manager does.
Okay.
So it is very important that you understand the fund manager and not the fund.
Understood, sir.
Most investors will do the mistake is they look at the past history. They'll see the expense ratio. All that is irrelevant when you're doing active fund manager.
Okay.
Active fund manager is all about the guy running the fund. So there are some fund managers, some parameters which you should keep in mind.
Okay. We should look onto it.
Yes. So one of the most important things is something known as aggressive and conservative style. What does aggressive and conservative mean to you?
So conservative means just going in a slow progressive style. Aggressive means we have to push everything in one at a time.
Correct. I am conservative. I'm always like to take my time and be careful.
Okay.
You, on the other hand, are aggressive.
Aggressive. Okay.
You always like to go, sir.
Yeah, sir.
Let's do this. Sir, this idea I have. Let's do this. Let's do that.
Yeah,
I'm like, Kesav, let's think about it. And this always gets you into trouble with Anand.
Yeah, sir. Yeah,
if anyone who's followed me and Kesav and catches him on Money Pitch, you can see him. How he gets caught always with his stumps with Anand. He won't bother protecting his stumps. He'll go running down the pitch trying to swing at the ball. And the ball will bounce and go through Kesav. And the stumps will disappear very fast when Anand is bowling at him.
Yeah.
So that's the difference between aggressive and conservative. So aggressive style is a fund manager who looks at short horizons.
Okay.
Okay. He's looking at short returns. He wants to maximize the profit. He's an aggressive kind of person. Keeps on buying.
Okay.
Conservative is a person who's a little more hesitant, who looks at a little longer perspective.
Okay.
So you can see it in their pattern, the fund manager, the way they're investing. Another is to look at is the guy is looking for value or growth. What is the difference in value and growth?
So growth means that gradually going is called growth. But
what is value?
Value means price.
Correct.
Price.
And always still, price is what you pay, value is what you get. Correct. So value is that. Some fund managers pick stocks which are have intrinsic value.
Okay.
The essence of value. Something inside the company itself is worthwhile.
Okay.
It might not grow great. It might not offer great returns, but it's a very valuable company.
Okay.
There's something about it. The product it makes, the moat it has. Some fund managers look only at growth stocks.
Okay.
That has a potential in the next 1 year, 2 years, 5 years to grow by 5%, 10%, 15%. They project, they think it's going to grow. So that you should look at that. Then another one is credit risk type. This means investor looking for debt funds must evaluate investment based on credit risk.
Okay.
So some of us look at investing in debt. Correct? In debt market, like the bond market.
Okay.
So some fund managers will take risky debt, the ratings of the debt. You have seen credit rating, debt rating is there. CRISIL rating. It will be AA minus, AA plus.
Yeah, sir.
The
I
bond
heard about
rating.
bonds.
Yeah,
sir.
bond rating
A1
is
bonds.
there.
Like
So since you, instead of buying individual bonds, you can buy into the bond market by investing in the debt market.
Okay.
But then you should check where the fund manager, which bonds he's buying.
Okay.
If he's buying junk bonds, you have a problem, you might lose your money.
Yeah, sir.
There's a huge risk involved in it. So you should evaluate if he is doing that, what kind of thing. Another important thing to look at is called the investing per the mandate.
Okay.
Mandate is, for example, a large cap mutual fund must have a minimum 65% of asset allocated to large cap stocks. I think this is changed now. But what a mandate is, SEBI has set a rule.
Okay, sir.
The rule is you should invest so much of percentage of your funds in these companies. So much percentage should be in like this. SEBI has passed these rules.
So that is what we talked in the HDFC, that
Correct.
10% of
weightage,
the weightage, they can't invest.
They can't
more than
invest.
that.
Yeah. So those rules are there. So you should make sure the fund managers follow the rules. What is the rules?
They have to follow.
Are they following these
Rules or
mandates
not?
on these rules? Okay. This is important because you don't want to get caught like Axis Mutual Fund. The guys playing around. If your funds got locked into it, you will get your money.
Yeah, sir.
But the harrowing process of will I get,
Yeah.
cannot get, how much will I get, and
Yeah, sir.
don't want to go through that. Next is the kind of horizon he looks at. Is he looking at short term or is he looking at long term?
Okay, sir.
So you can see this. Is he frequently buying and selling? It's called churning the portfolio.
Okay.
Every month, every 6 months, he's buying and selling lots of shares. Or is he buying and holding? Like Anand says, value investing. He buys these ITC shares at this low price. Then he's just been holding it and holding it.
Yeah,
Returns are coming. Because growth is there.
Okay.
You can see it.
Sir, but I have a doubt, sir. There are some fund managers who do like this. They invest on some company. If the company is drop by 1 or 2%, they will just sell the stocks and get back the money, and they invest on something, some company which grows rapidly. Is that the right way to do the investing, sir?
That's your personal choice. I would say no.
They are called the aggressive.
Yes.
Okay.
Where they're churning the portfolio.
But their portfolio is too good, sir.
That's what I'm saying. You're not looking at it correctly. If you take it apart and look.
Okay.
That's why Warren Buffett famously said, and Anand has also been telling you over and over again, which you're not getting into your head. Okay. Which is what? He says, over the long term, let's say you take over a 5 year, 10 year time, the no active fund manager beats the passive fund.
Okay.
Because it's impossible. It's very difficult to beat the passive fund. Because the thing is, the active fund manager is taking money out of it to pay his self. While in a case of a passive fund, it's not. All the money keeps going for investing.
Just grows and grows.
Grows and grows.
Okay, sir.
Okay.
Understood, sir.
Right. So, this is one thing important, which I told you. Does it keep churning the portfolio?
Okay, sir.
Then, another important thing is, should you leave? Let's say you found out Anand Srinivasan, now fund managers. You found a fund manager who you really like, who talks the way you talk, and does everything you do. One crucial thing is these fund managers leave, like how your favorite professor leaves the college and goes, and one idiot professor comes the next day, you go and you're like, my favorite professor is gone.
Yeah, sir.
Should we leave the college and go behind that professor?
No.
That is the same question I'm going to ask you. If the fund manager is so important, if he leaves the fund and he goes, should you sell everything in the fund and move to some other fund?
No. How can I do that, sir?
Why?
So because I believed in him, so I invested in that. After
he's left, he's not there anymore, no?
Yeah, sir, but my money keeps growing, no? How can I take that?
How do you know the next guy is going to do the same thing?
Yeah, now I got a point, sir. Okay, sir.
Because the next guy can come, he can be Vinod Srinivasan of fund managers. He might come and say, hey, sell all this. He might be the case of fund managers. Which is even better.
Then definitely I will sell once the fund manager leaves, sir.
Correct. So, if you think about it, in conclusion, what all should you do? A fund manager has a potential to turn mutual fund returns in favor of investors, and hence investors evaluate a fund manager's performance, but you may not evaluate a fund manager on above parameters. But knowing them on a few parameters will surely help you pick the right mutual fund. So in the result, what he's saying is, yes, look at the mutual fund.
Okay.
but also give equal weightage to the fund manager.
Okay, sir.
Correct. So if you've invested in a fund because of a specific fund manager, like how you decide to leave a fund, you should also give weightage to if the fund manager changes also.
Once he leaves, you have
Yeah,
to.
like how Anand keeps on saying, the integrity of the owner of the company is important.
Yeah, sir.
Correct. The integrity of the fund manager is also important.
Understood, sir.
Not only do you look at the history of the fund, like how you look at the history of the company, the balance sheet and all that. Then Anand says important is also who is running the company. Same way, looking at all the evaluations of a fund is important, but also who is running the fund is also important.
Yeah, sir. Whenever Anand sir always tries to, always says that whatever Tata stocks you buy, you don't have to fear. And you don't have to scared of that. Then I asked, Tata also is making losses. Why we don't have to fear that? He always says, I know about Ratan Tata. He won't let people down. So
History is there.
Just follow that.
The history is there. Like famously before the camera turned on, we were talking about what was happening in Reliance and Tata's. And you were saying in Reliance, his full Khandan is taking over the company.
Yeah, sir.
Slowly, his son is coming, his daughter is coming. And you heard what we spoke about Reliance Retail. The way he's giving the raw deal to some of his investors. That doesn't happen in Tata's. Tata's also, like Tata Docomo, went through a bad phase. But they make it a point, investors don't lose. See, the Tata says, I'm doing a business. Like Tata Play, he was going to an IPO, he withdrew the IPO. Because he knew it was going to be a loss making. He didn't want to steal fund investors' money. He says, yes, you believe in me and believe in my business and you invest. If I fail, I return your money. I may not give you a profit, but I return your money. With Reliance, you never know. Same thing is true with the fund manager. I rather bet on the fund manager than the fund.
No.
So that's what's important. The essence of the video is that pay more attention to the fund manager. If you are going to go, the reason why Anand says go passive funds is because passive funds don't have a fund manager.
Okay.
There's only one rule. You invest on the index. Your funds are divided equally according to the index weightage. Then whatever Nifty is divided into percentage weightage wise, the same way your money is divided and invested. And that's it.
There's no need of a fund manager.
There's no fund manager who's fiddling and fiddling with your investment. You don't have to worry.
Understood, sir. Understood, sir.
Okay, and in the long term, passive fund always wins. That's why he says. But if you need some short term trying to do market play and all that, and you think this guy is a much better guy managing my money, your friend is advising you, please check the guy who's running it.
Okay.
You don't want to land up with the Wolf of Wall Street. Some pump and dump scheme. Okay?
Understood, sir.
Chalo. Anyway, thank you for watching this video. I hope you found it informative and entertaining as always. Please do subscribe to our channel and turn on the bell notification. And Anand will be back soon to discuss something of more importance and relevance to you, I'm sure. Thank you for watching our video today.
Thank you.